Imagine the financial hubs, Mumbai, New Delhi. You can feel the energy, right? But lately, there's this tension underneath. The Indian rupee, the cornerstone of the economy, it's under some serious pressure.
Yeah, serious pressure is right. It's what you might call a rough ride, and it's shaking more than just the currency markets.
Absolutely. The rupee isn't just like a number you see on a screen. It feels like a symbol for these bigger economic shifts, maybe even geopolitical ones.
It really does. It shows just how interconnected everything is. Decisions made, miles and miles away, they can send ripples right through millions of lives.
So that's exactly what we're diving into today, this rough ride. We want to unpack the story behind these recent U.S. tariffs, see how they're hitting India's economy, and crucially, what it means for everyday people.
People like the diamond workers in Surat or maybe the garment artisans in Delhi. We need to look at the causes, the consequences, and also how India's fighting back. It's quite a story.
It really is. Yeah. And just to set the scene, the rupee, it closed at 88.20 against the U.S. dollar on September 1st. That's 2025. It hints at this bigger picture, right? Record lows, maybe more slides to come. So what exactly kicked off this intense pressure right now?
Well, the immediate trigger, the thing that really hit hard, was this dramatic surge in U.S. tariffs. As of August 27th, 2025, a staggering 50% U.S. tariff got slapped onto Indian exports.
50%. Wow.
Yeah. And the critical thing is this wasn't like out of the blue static decision. It actually doubled. It was 25% just a few weeks before on August 7th. So you see the escalation.
Doubled in just a few weeks. That's not just a number, is it? That's a huge barrier for anyone trying to sell goods to the U.S.
Exactly. Imagine you're that diamond crafter in Surat or maybe a textile worker down in Tirupur. Suddenly your products are way more expensive in what is, for India, its biggest market.
And let's underline that biggest market. It's not just a partner, it's India's largest trading partner. We're talking, over $190 billion in trade every year?
That's the scale we're dealing with. So yeah, a 50% tariff isn't some small tweak. It's like throwing a massive wrench into a huge economic engine.
So what's the reason given? What's the catalyst for such a drastic move from the U.S. side?
The stated reason, coming from U.S. President Donald Trump, points directly at India's ongoing purchase of discounted Russian oil.
Ah, the Russian oil angle. That's been controversial.
It has. India's imports of Russian crude they've surged. They now account for over 35% of India's total crude oil imports, and the estimated savings from that. Around $17 billion since 2022.
$17 billion. Okay, so the U.S. sees this as...
The U.S. perspective is that this is profiteering. They argue it undermines the international efforts aimed at weakening Russia's economy through sanctions and, energy pressure.
Right, so the U.S. feels India's moves are working against its strategic goals, essentially gaining an advantage while undermining sanctions.
That's the accusation. But India naturally defends its strategy quite fiercely. They frame it as a necessity.
A necessity? How so?
Well, for a country with 1.4 billion people, keeping inflation in check, especially for essentials, is absolutely paramount. Accessing cheaper crude helps manage those domestic prices.
Okay, so it's framed as a domestic economic imperative.
Precisely. And it's important to note this didn't just happen overnight. There were actually 5 rounds of negotiations, attempts between New Delhi and Washington to try and cap these tariffs at something more manageable, maybe 15%.
But those talks failed.
They did. All 5 rounds ended without agreement, which signals a pretty significant breakdown in finding common ground.
And knowing that diplomacy failed just makes the impact seem even harsher.
Yeah.
These tariffs, they're not just hitting one or two things, are they? It sounds like broad sectors are affected.
Oh, absolutely. The pain is being felt widely. We're seeing pharmaceuticals, textiles, electronics, all facing these steep costs immediately.
And these aren't small sectors.
Not at all. These are industries that employ millions of people across India. Their products just became much less competitive in the U.S. market almost overnight.
Which brings us right back to the rupee itself. With such a direct hit on trade, its biggest export market. How is the currency actually holding up? Because it feels like more than just a dip.
It really is more than a dip. It's been a relentless slide. Now, the rupee has had its struggles before, but these tariffs have really intensified the pressure dramatically.
So what are the numbers looking like?
Well, on September 1st, 2025, it hit an intraday low of 88.34 against the dollar. That's a record. And just looking at August 2025, it fell 0.7%.
Okay.
That marked its 4th straight month of decline. And year-to-date, it's down 2.93%, making it the worst-performing major Asian currency.
Worst performing in Asia. That's a pretty stark signal. Now, I know India Central Bank, the RBI, they usually step in, don't they? Are they trying to fight this?
They are definitely fighting. The Reserve Bank of India is actively intervening, but many analysts are calling it a losing battle right now.
What does that intervention look like?
Primarily, they're selling U.S. dollars from their foreign exchange reserves to try and, prop up the rupee's value. Buy rupees, sell dollars.
And is that costing them?
Significantly. Just in the recent period leading up to August 22nd, 2025, their reserves depleted by about $5 billion. They fell to $691 billion.
Wow, $5 billion just like that. And where were they before?
They peaked higher, around $704.88 billion back in September 2024. So you can see the drain. It shows the scale of the fight and the resources being poured in just to try and stabilize things.
So it sounds like it's not just the tariffs then. You described it as a perfect storm earlier. Are there other pressures piling on top of these trade issues?
Yeah, perfect storm feels apt. If you zoom out a little, it's really a confluence of factors. The tariffs are the big, immediate shock, but other things are adding to the strain.
Like what?
Well, first, you've got foreign portfolio investors, FPIs. These are basically big global investment funds. They've been pulling money out of Indian stocks in a big way. We're talking a staggering Rs 1.4 trillion sold off in Indian equities this year alone. And just in August, they dumped Rs 35,000 crore. That kind of outflow puts immense downward pressure on the rupee.
Okay, so foreign money leaving. What else?
Then there are rising bond yields. The yield on India's 10-year benchmark government bond hit 6.7% recently, before easing back a bit to 6.59%. Higher yields mean it costs the government more to borrow, but it also signals increased risk perception, which can dampen investor confidence overall.
Right, makes India look a bit less attractive for investment.
Exactly. And finally, don't forget soaring gold prices. India imports a huge amount of gold. It's culturally significant, but also a major import cost. When gold prices go up, it strains the country's current account balance, that gap between money coming in and money going out.
So imports become more expensive, the trade balance worsens, adding even more pressure on the currency. It really is a combination punch.
It is. The tariffs expose some vulnerabilities, but these other factors are definitely amplifying the problem.
Okay, we're talking huge numbers, billions in trade, trillions in outflows, reserve depletion. But what does this actually mean for people, on the ground? It's easy to get lost in the macro figures.
That's such a crucial question. How does this filter down? And the answer is it becomes profoundly personal very quickly.
Can you give us an example?
Sure. Think about someone like Jinal Abedin. He's described as a highly skilled artisan in Delhi, spent a year mastering intricate Zardozi embroidery. He works creating designs for factories supplying big U.S. brands, like Gap and Ralph Lauren.
Okay, so skilled work for major international brands.
Exactly. But now, with these 50% tariffs, those U.S. brands have just stopped placing new orders, halted completely. So for workers like Jinal, the immediate fear is layoffs. Their livelihood is suddenly hanging by a thread.
That's incredibly tough. Years honing a craft, and then a trade dispute pulls the rug out. What about other big employment sectors?
Let's look at Surat. It's the world's diamond hub, right? Processes something like 90% of the planet's rough diamonds. It employs an incredible 5 million people.
5 million people in just that industry cluster.
Yes. And they're now bracing for a potential 20 to 30% drop in exports because of these tariffs. Someone from the Gem and Jewelry Export Promotion Council, Jayanti Haisavalia, called it a wake-up call for the industry to diversify its markets. But, finding new buyers isn't easy. It doesn't happen overnight.
No, that takes time and effort. Any other examples?
Tariff, down south. It's known as India's textile capital. Same story there. New orders from the U.S. have basically stopped. This industry is vital. It accounts for about 2% of India's entire formal economy. Millions of jobs are at risk there, too. Factory owners are actually pleading for government help just to keep paying wages.
So the impact is direct, immediate, and potentially devastating for these export-focused workers and industries.
Very much so. And the ripples don't stop there.
You mean it affects people not directly involved in exports, like the middle class?
Absolutely. India has this massive middle class, maybe 400 million people strong. Their spending power is huge. It drives about half of the country's total consumption.
Okay, so what's the connection?
A weaker rupee makes anything imported more expensive. Think about fuel for your car or scooter, electronics like phones and laptops, even imported food items in the grocery store. All those prices go up.
Right. So it directly shits household budgets. Less money for other things, less saving.
Exactly. It squeezes their purchasing power, which can then lead to a broader slowdown because people just aren't spending as much across the economy.
This really paints a picture of the RBI being caught in a very difficult position, doesn't it? Trying to manage this rupee slide. What are their options strategically?
They are in an incredibly tough spot, a real dilemma. Option one, keep doing what they're doing, burn through more of those precious foreign exchange reserves to defend the rupee, try to keep it from falling further.
Okay, defend the currency. What's option two?
Option two is to maybe strategically let the rupee slide further. There's an argument put forward by people like Amit Pabari at CR Forex Advisors that a weaker rupee could actually help offset some of the tariff impact.
How would that work?
Well, if the rupee is cheaper, Indian goods become cheaper for foreign buyers, even with the tariff added on. It could make exports more competitive again.
Ah, okay. So let it fall to gain a price advantage. But that sounds risky too.
Extremely risky. The big danger there is inflation. If the rupee weakens further, all those imports we just talked about, especially critical ones like oil and gold, become even more expensive domestically. That could push inflation higher, hurting ordinary citizens even more.
So it's a trade-off. Try to help exporters but risk higher prices for everyone, or try to stabilize prices but keep pressure on exporters and drain reserves. A real tightrope walk.
Precisely. It's a high-stakes balancing act between short-term stability and maybe longer-term competitiveness, and every path has significant consequences for 1.4 billion people.
You mentioned the cost of intervention earlier. How much have these efforts drained reserves overall, and what are the longer-term worries there?
Since the pressure really ramped up around September 2024, the RBI's interventions have cost about $13 billion in reserves. That's a substantial amount of India's financial cushion.
$13 billion.
Yeah. And if they have to keep spending reserves at that kind of pace, it definitely raises concerns about India's overall economic stability and its ability to handle any future shocks that might come along.
And what about the general economic outlook? Does that make the RBI's job easier or harder?
It actually makes it harder because the forecasts themselves are conflicting. It's not a clear picture.
Conflicting. In what way?
Well, on one side, you have relatively optimistic views. Fitch Ratings, for example, is projecting robust GDP growth of 6.5% for the next fiscal year, FY26. They point to strong government spending and resilient private consumption. The hope there is that India's fundamental strength will help, and maybe, just maybe, negotiations will eventually ease the tariffs.
Okay, so a growth story despite the headwinds. What's the other side?
The more cautious view warns that if these high tariffs stick around for too long, they could easily shave, say, 0.5 percentage point off India's GDP growth, especially if all this uncertainty makes businesses hesitant to invest and expand.
Right. Uncertainty is poison for investment. So the RBI is navigating this tricky path with a really unclear destination.
Exactly. The path ahead looks quite uncertain, adding another layer of complexity to their decisions.
Moving beyond the pure economics for a moment, how much of this feels like it's tangled up in broader geopolitics? It seems like more than just a trade spat.
Oh, it's deeply intertwined with geopolitics. You absolutely can't separate the trade issue from the bigger strategic picture. It feels very much like a significant move in a larger geopolitical chess game.
And the key piece on the board seems to be that Russian oil connection.
That's certainly a major flashpoint. India's purchase of Russian oil, as we said, has skyrocketed from maybe 1% of its imports back in 2021 to over 35% now. India consistently frames this as being driven by national interest.
How does India define national interest here?
The argument often articulated by Foreign Minister Jaishankar is that for a country consuming 5 million barrels of oil every single day, accessing discounted crude is vital for managing inflation and energy security for its vast population.
Okay, so energy security and inflation control. But the U.S. has a specific counter-argument, right?
Yes. The U.S. Treasury Secretary, Scott Bessent, has been quite pointed, accusing India of essentially exploiting an arbitrage opportunity.
Arbitrage, meaning?
Meaning buying the cheap Russian crude, refining it into products like petrochemicals, and then selling those finished products on the global market, possibly even into markets adhering to sanctions. The accusation is that this benefits India, perhaps specific wealthy families, while circumventing the intended impact of the sanctions on Russia.
That's a serious accusation. It puts India in a really difficult position, doesn't it?
It really does. It's a classic balancing act. On one hand, the relationship with the U.S. is crucial. It's a key defense partner, a massive trade partner. On the other hand, Russia remains a very important supplier of military equipment for India. So India is trying to maintain its strategic autonomy, its ability to make decisions based purely on its own interests, but that's being severely tested right now.
And how do other players, like China, fit into this picture?
That's another interesting layer. China is also a major buyer of Russian oil, but the U.S. tariffs imposed on China are comparatively lower, around 30% versus India's 50%.
So that gives China a competitive edge over India in some ways.
Potentially, yes. It could make Chinese goods relatively cheaper than Indian goods in the U.S. market, adding another competitive pressure point for India.
It sounds like a very high-stakes diplomatic game. Are there any key moments coming up where we might see some movement?
All eyes will likely be on the United Nations General Assembly meeting coming up in September 2025. Prime Minister Narendra Modi is expected to be there, and so is President Trump. Any interaction or even just the speeches they give could be really pivotal for signaling potential shifts in stance or opening doors for negotiation.
Definitely something to watch. Now, despite all these challenges, the tariffs, the currency pressure, the geopolitical squeeze, India isn't just standing still, is it? They have a reputation for resilience. What's the fight back looking like?
You're right, resilience is key here, and India is definitely taking proactive steps. It's worth remembering that even with these headwinds, the economy grew a pretty strong 7.8% in the April to June quarter of 2025. That exceeded expectations and shows some underlying strength.
Okay, so the fundamentals are still there to some extent. What specific measures is the government taking to counter the tariff impact?
They're rolling out targeted support. Things like subsidies specifically for exporters to help them absorb some of the tariff cost. Also, providing liquidity support, basically ensuring cash flow to vulnerable sectors like textiles and gems, with the explicit aim of trying to maintain employment levels.
So, trying to cushion the blow for the hardest hit industries and workers. Are they also looking outwards, beyond the U.S. market?
Absolutely. Diversification is a big theme. The Commerce Ministry is actively identifying and targeting around 50 new potential markets for Indian goods, especially focusing on areas like textiles, leather, and marine products. It's a clear strategic push to reduce that heavy reliance on the U.S. market.
Makes sense. Spread the risk. Anything happening on the domestic front to maybe boost the economy internally?
Yes, there's talk of a significant goods and services tax, or GST, reform. The proposal aims to boost domestic consumption, perhaps by easing the income tax burden, which can be quite high, 30 to 40% for middle-class individuals earning above R15 lakh per year.
So putting more disposable income back into people's pockets could stimulate demand at home, potentially offsetting some of the export weakness.
That's the idea, bolster internal demand as a buffer.
And I've also heard discussions about India leaning more into the BRICS group. Brazil, Russia, India, China, South Africa, and the newer members. Is that part of the long-term strategy too?
It very much seems to be. India is actively pushing for a stronger BRICS-led trade framework. Trade among the BRICS nations already hit $250 billion in 2024, which was up 15%.
Okay, so that's a growing block. What kind of initiatives are being explored?
There's a proposed free trade agreement within BRICS. The idea is to have low average tariffs, maybe around 5%. Estimates suggest this could add something like $60 billion to India's exports by 2030.
60 billion is a substantial number. What about reducing reliance on the U.S. dollar?
That's another key pillar. There's a push to scale up trade using local currencies, like the existing Rupee ruble mechanism with Russia, which apparently handled about $10 billion in trade in 2024. The broader goal is to lessen dependence on the U.S. dollar, which, through systems like SWIFT, still dominates, almost 88% of global trade settlements?
So building parallel systems, essentially.
Yes. And going even further, India's finance minister, Nirmala Sitharaman, has been quite vocal about exploring the possibility of a BRICS-backed common currency, or at least a BRICS-backed credit rating agency.
That's BRICS currency. That would be a major shift.
It would be huge. The underlying aim seems to be challenging the long-standing dominance of Western financial institutions and creating more financial autonomy for these major emerging economies. It's definitely an ambitious long-term vision for a different kind of global financial architecture.
So we've covered the storm hitting, the rupee slide, the very real human cost, the RBI's tough choices, the geopolitics, and now India's multifaceted fight back. Looking ahead, what's the immediate outlook? Where might things go from here for the rupee and the wider economy?
Well, the near-term outlook remains, frankly, quite uncertain. Many analysts, like Anil Kumar Bansali at Finrex Treasury Advisors, believe that if these 50% tariffs persist, the rupee could well test the 89 or even 90 level against the dollar.
So potentially further weakening is on the cards. How have the markets reacted most recently?
The stock market certainly reflected the anxiety. On August 27th, the day the 50% tariff kicked in, both the main indices, the Sensex and the Nifty, dropped about 1% each. Now, 1% might not sound like much, but in value terms, it wiped out something like Arta's 6 lakh crore of investor wealth in a single day.
6 lakh crore. That's a massive hit in one session. It shows the level of concern. But you also mentioned India's underlying strengths earlier. Do those still count for something amidst this volatility?
They absolutely do, and that's important not to forget. Despite the immediate pain points, India still has fundamental buffers. It has that robust growth potential we talked about, a huge and young workforce, and there is an ongoing commitment to strategic reforms. These are significant long-term advantages.
But for the average person listening, the immediate concerns are probably more tangible.
For sure. For the common person, the stakes remain very direct and very clear. A weaker rupee means, quite simply, things cost more. Pricier fuel, more expensive groceries, higher costs for imported gadgets and goods. That impacts households across the board, urban and rural. For those in export industries, it means dwindling orders and real fears about job security.
So it's this mix of immediate hardship and anxiety, but also a longer-term strategic maneuvering playing out.
Exactly. You see the immediate economic pain and the human cost, but you also see India drawing on its historical resilience. There seems to be a clear intent to try and turn this crisis into an opportunity, pushing harder on market diversification, enacting domestic reforms like the GST changes, and really leveraging those BRICS partnerships as an alternative path. The goal isn't just to survive this storm, but potentially to emerge from it stronger and more strategically independent in the long run.
This has been a really fascinating and frankly quite sobering deep dive into a complex situation. As you listen to all this, think about what it really means for a nation like India to navigate this global landscape, trying to balance its own national interest against intense international pressures. It really makes you consider that idea of strategic autonomy in a world that's so deeply interconnected. What trade-offs are actually justifiable when people's jobs and livelihoods are directly on the line?
It's a profound question, and there really aren't any easy answers, are there? The ripple effects just keep spreading, reminding us constantly how linked our economies and our futures truly are.
We really encourage you to stay curious about this intricate global dynamics. Thanks so much for joining us for this deep dive.